But geopolitics isn't the only story that's been rattling the market. There are also concerns around private credit and its exposure to software, which led to an exodus of investor money from private credit funds. The biggest lenders going on media tours to downplay the risks, although Apollo Global's John Zito is calling out the industry as being arrogant in a recent Wall Street Journal article. He also called out one firm in particular, Thoma Bravo. And that brings us to our first guest today. Orlando Bravo is founder and managing partner of Thoma Bravo. He joins the program alongside our very own Leslie Picker. Leslie?
Kelly, thank you very much. And Orlando, thank you for having us. We're here at your Investor Day in Miami, the largest investment firm exposed to software. So it's a really critical time to be having these conversations. And I'm just curious to just address the elephant in the room here. Are your LPs freaking out about everything that's happening with private equity and software right now?
First of all, it is so awesome, Leslie, to have you here at our annual meeting. Our LPs are relieved. You know, just in the hallway after our morning session, one of our biggest LPs comes up and says, "Thank you for having this conference, your annual meeting, at this time. 2 weeks ago, I'm just reading the news and reading about all these SaaS problems in the public markets. This was a great day to walk our partners through the details of our 77 companies and those fundamentals." And what they see is, for the most part, our companies are crushing it. Our companies are incredibly positioned to be winners in the agentic era, and our companies are well on their way toward becoming AI-centric companies. So I think relieved and back to fundamentals and back to the details of the companies has been very nice for them.
So do you think there's something different about the companies in your portfolio than the public markets? Because you look at just the S&P Software and Services Index, it's lost a quarter of its value since October. I mean, is this a sector issue, or is there something idiosyncratic about what you're seeing in your own portfolio here?
Well, first of all, we've been doing software investing, over 500 acquisitions over the last 25 years. We have been living in the details of the space for a very, very long time, and not at a high level, not investing in stocks, investing in companies, customer contracts, knowing the details. So yes, as a sector specialist in private equity, our companies are very, very different than public companies. Now, in the public markets, if you look at it, there are many, many software companies in the public markets that will be disrupted from AI. Those companies were going to be disrupted anyway. AI will create that disruption a lot faster. And some of the decreases in their valuations are very warranted. And we would have no interest, for example, in buying those companies. Now, there are other, and many of them out there in the public markets, where this is unjustified, where there are phenomenal businesses that are actually going to be big winners in the agentic era, and those companies have been severely punished when they shouldn't have been.
What does it mean for valuations in your own portfolio? I mentioned the S&P Software and Services Index losing a quarter of its value. Do you feel the need to mark down your own portfolio by a similar magnitude, or how are you thinking about the valuation changes given what we're seeing in the public markets right now?
It's not close to the same magnitude. Of course, we have to use public comparables to decide on the values, along with our advisory committee, on the value of our companies every quarter. But we have never marked our companies close to the public comps. I mean, we are fundamental investors that mark our companies on EBITDA, free cash flow, and net income. Those multiples in the public markets have gone from 22 times forward EBITDA to about 17 today. In general, these are still very healthy levels, and we can earn excellent returns at those exits or at those levels.
The Wall Street Journal, of course, publishing a piece yesterday, Kelly referenced it in the intro, where they quoted comments made by Apollo co-president John Zito in what was supposed to be a closed-door meeting, but he said that, quote, he literally thinks all the marks are wrong, private equity marks are wrong. Do you think there's some truth to that?
I cannot comment on other people's marks. That is not my business. I don't know the details of those companies, and I frankly don't know those marks. We have here with us literally 100% of the largest state pension plans in the US, and literally all of the sovereign wealth funds of size in the world. Many of those have been our partners for 25 years. They have seen our marks, they have seen our exits, they have seen our progression. And everybody's extremely comfortable, and we're extremely transparent. as to what our companies in general are worth.